Hey, welcome back to another video. Today we've got a longer one. We've got one that is going to be a little bit more detail oriented. Some days I wake up and I just want to put out a simple message about what I'm buying, something simple, something inspirational, whatever, something that's in the news. But today I woke up and chose violence. So you're going to learn today. It's going to be a little bit longer, more data driven. I'm going to show you guys a little bit of what I've been doing in the market and some economic indicators. So I would like to do this every Sunday. However, given my schedule, I don't know if that is feasible until I get back to a more established civilian routine. So let's go ahead and slide into the Robinhood portfolio, and I'll let you guys see a little bit of what I've been buying here. All right, here we go. So I want you guys to take a look at the Robinhood portfolio here. So we've got two buys that went through on March 19th. So that was Friday. We saw a little bit of a dip in the NASDAQ on Friday. So we got some little baby buys here. TTCF for $60, 2.95 shares at $20.28. And we've got another buy for $50 at $20.71. So we've got two buys here. I basically wanted to show you guys this because if I can go in here and let's go look at TTCF, if we can get this to load. We saw a little dip at the beginning of the day, and that thing was just going down insanely. It went down, got down 4.26%. So I thought, hey, this is a great buying opportunity for TTCF. So if we go back here, we see that TTCF has been downtrending a little bit. We go back to the year chart, and the lowest it's gone is 15. We see 14 back here. We see 13 back here, and it IPO'd at 9. So I just figured, hey, there's a little bit of support building up for TTCF around 19 to 15 range. So I want to start building up a little bit of a position. My position currently is $326 in market value. And I'm still down on the position, but that's a good thing in my view, because when you first start buying something, you want it to get cheaper. You want to be able to build up a base of that position. I could see myself building that into maybe a $2 to $3 grand position. So the fact that it's down right now, that doesn't matter because I still plan on putting a little bit more into that position. So anyways, wanted to show you guys that buy alert. Another one that I've also been looking at is Corsair Gaming. That one looks really good. I need to look more into that one. And anyways, we'll look into these different economic indicators that I want you guys to pay attention to, because the Federal Reserve just came out and talked about these, and these are going to drive the markets. So first one we've got is new housing starts. So as we can see here, since the beginning of the pandemic, we saw a dip in new housing starts. Then we saw an increase as the Federal Reserve started printing money. And now we're seeing a little bit of a dip. We're seeing a drop off in new housing starts. So the reason why we're seeing that is because the materials that go into houses are starting to go up in price. The reason why this is an important economic indicator is because, check it out, we look at all these recessions. These recessions are here in the gray bars. And as we look at the recessions, we see that they usually have a lower new housing starts level, right? We see a decline in new housing starts. So it's a good economic indicator, and we're starting to trend down there. Okay, so unemployment. I like to look at U6 unemployment, because U6 unemployment, as we see, it's got total unemployed plus marginally attached workers plus total unemployed plus total employed part-time for economic reasons as a percentage of the labor force. So for the US right now, we see U6 is at 13.6%, or U3 is at 8.1%. So this is based on 2020. And essentially what we see is a really high level of U6 unemployment. And the funny thing to me, this was kind of just amusing, is that I saw that the worst two areas are Los Angeles County and New York City. So interesting coincidence there. The lockdown champions, they're experiencing a lot of unemployment, which of course leads to poverty. All right, the next thing that I wanted to show you guys is the US 10-year Treasury. So we spiked up to 1.73% on the 10-year Treasury. For those of you guys out there that don't understand, why is everybody talking about this 10-year Treasury? That's because that when companies go out and they get loans, it's based on that benchmark of the US Treasury, right? So that's basically called the risk-free return. So if you're going to get a loan, it's going to be linked to that risk-free return. So as borrowing becomes more expensive, things like cash flows for businesses will go down. And additionally, if you're in, say, like a growth stock or something like that, the future cash flows for that growth stock will be discounted because they're going to have to borrow at much higher rates, and the opportunity cost is a little bit greater when you could already make a much higher yield in the Treasury. So why are these 10 years spiking? These 10 years are spiking because of inflation fear. So the Fed has said that they're going to keep inflation at a moderate, slightly above 2%, but the market is not buying it. So let's move on to the next thing. Median sale price of houses. Sorry, I don't know why I couldn't say that. Okay, so we see that in the GFC, we saw obviously a housing crash. However, for this one, we're seeing home prices are still ticking up. One interesting thing about this is that we're seeing home prices ticking up because the interest rates are low, right? Interest rates and home prices are inversely related, because as your interest rate goes up, your home payment gets more expensive, so you cannot sell the house for as much money. But one interesting thing about this statistic is that a lot of the people who are refinancing into new mortgages were super prime borrowers. I think it was 85% of people who refinance were super prime borrowers, which makes sense because, I mean, people who make good financial decisions are making good financial decisions. They're lowering their house payment during this opportunity. So that is interesting because not a lot of those people are actually going to lose their house, right? They're people who make good financial decisions. So the fact that home prices are going higher right now, it also reflects the fact that, you know, mortgages are being forgiven, rents are being paid, a lot of stimulus is going out into the economy. But that's one interesting thing to look at, is to see where are these house prices going? Because if we see a reversal in interest rates, for example, in the 30-year and the 10-year, we could see those house prices start to tick back down. We've seen a long bull run ever since 2008. So moving on to the next one, manufacturing. So manufacturing basically tracks the actual real goods that are being manufactured in the economy. So we see that is actually ticking up pretty nicely. It took a huge nosedive right when the pandemic started, but ever since then, it's been ticking up nicely. All right, we already went through TTCF and Industrial Production Index. We already went through that. Let's move on to the next thing. Okay, crude oil prices. I want you guys to keep an eye on crude oil prices because they started to actually level off recently. So last week, we saw actually a tick down. I think it was $5 on WTI and $5 on crude. We saw a decrease in oil prices as jets and travel and things like that. The demand has actually been a little bit overestimated. So we're thinking that oil prices will continue to trend down. I'm thinking that, or that's what the market is thinking rather. I'm thinking that they will continue to go up as more stimulus goes into the economy. Just in nominal terms, I think that oil prices will go up. What we are seeing is a lot of lockdowns. We just saw a big protest over in London that there's more lockdowns. There's more daily cases. I think they just saw the biggest day since January. So cases are going back up. Lockdowns are coming back to the EU. But other countries are opening up. Other countries are seeing a downtick. Other countries are seeing a more successful vaccine rollout than the European Union. But anyways, that's something to keep your eyes on, is oil prices, because oil prices actually have a huge effect. It's an input cost on a lot of other things as well. Not to mention if you actually want to invest in those oil stocks. So I'm still bullish on oil long term, but however, what they call a one-way trade is definitely starting to turn around and go back down. Nothing can go on forever. So oil price charts, no, we're gonna skip that. Okay, inflation. We got to keep our eye on inflation. So I just wanted to point out this to you guys. It's a historical chart of inflation. So we see, what are we over here? 1914, that's the year after the Federal Reserve went into place. We see huge inflation right after the Federal Reserve. Look at that, 20% in 1918. Then we see deflation when we go into the 1920s. Deflation. We see a little bit more deflation. We see price decreases till 1933 when we go and we had the New Deal, where they did things like, one crazy thing they even did during the New Deal was they literally went up to farmers and they killed thousands of piglets so that they could restrict the supply of pork. They did things like that, like market manipulation, so that they could just restrict the supply, make it so that farmers were making more money because they would pay farmers to do things like leave some of their land unused. So point being, we saw inflation pick up after that year, after the New Deal, after all the government spending, after all the social programs went into place. And ever since then, we've only seen 1938 was deflationary. We see a lot of inflation after that. 1949 deflationary, 1954 deflationary. 1971 we broke from the gold standard, and after that inflation has taken off, and we haven't seen a single deflationary year after that. So inflation, definitely something to look at as far as losing your purchasing power in real terms. Another way to think about this inflation graph is this is how much money, how much purchasing power you lost each year by holding cash. So right now I'm not holding really any cash. I'm holding my emergency fund, and other than that I'm not holding any cash. So let's go into gold prices. So this is gold prices in nominal terms. What I'm showing you guys is gold prices in nominal terms. So we see over time, gold prices have ticked up, especially after 1971. It's been not really, I wouldn't call it an investment, but a good security against the money printing that goes on within our country. So what else did I want to say about gold prices? Okay, these are some unofficial statistics as far as the inflation. So if you take inflation and you measure it in terms of how it was measured in 1980, you see that our current rate of inflation is about somewhere between 6 to 8%, right? It spiked up 6 to 8% versus the about 2% or low inflation that they've been calling recently. But essentially, gold prices, what I wanted to say about gold prices is that they're starting to tick back up a little bit. But one negative thing for gold prices is when people expect inflation, they start to, gold is basically a zero coupon bond, right? So when people start to expect inflation, bonds start to sell off, interest rates start to go up, and that's a negative for gold. So it'll be interesting to see what happens with gold prices, but if inflation really does start to take off, and then gold prices should go up in nominal terms. So I'm looking at some gold miners. I'm not really as interested in gold itself right now. I might buy some actual physical gold, but not super interested right now. I'd rather get a productive company. All right, so moving into the next thing, consumer confidence. So consumer confidence, I meant to give you guys how it's calculated here. So consumer confidence is basically, they do a survey of how people are feeling about business conditions, about their job conditions, about whether or not they're going to have an income. So their questions that they're asked are current business conditions for the next 6 months, current employment conditions for the next 6 months, total family income for the next 6 months. So basically they ask them whether they're positive, negative, or neutral about those things, and they make this consumer confidence index. So before the pandemic, we were at 101. We went down to 71.8 at the peak of the lockdowns and everything, and we're still at about 76.8. We've been trending down a little bit in recent months. So that's a little bit of a negative sentiment, and that has predicted a lot of recessions in the past. So when consumer confidence goes down, people basically don't think that they're going to have any money in the near term, so they stop spending as much money, and that is the precursor to a crash in the economy. So last thing I wanted to show you guys is how the sectors are doing. So I want you guys to check out how the sectors are doing. Actually, I want to show you one thing after this, but I'm just going to really quickly. This is the S&P 600 sectors. So these are basically small caps, right? This is how the small companies are doing. What we see here is we see that consumer discretionary in the small caps is outperforming right now, which makes sense. We're opening back up. These small consumer discretionary companies are starting to open back up, starting to make a little bit more money. We see small energy companies outperforming, and we see utilities underperforming, which makes sense. If you're expecting inflation, and you're expecting, and also if you're having all of this money printing, you're having all of this money going into the market, then a lot of these technology companies, they're going to outperform, right? You have a lot of money sloshing in the market. Real estate, we see that real estate is underperforming. So one thing that I wanted to point out to you guys about this is that, for one, the S&P 600s are outperforming the S&P 500. So let's go over here to S&P 500s. So we see that a lot of these, we see energy right here in the S&P 500 is outperforming, but then we see the rest of these having a much lower performance, right? Same thing in the S&P 400 mid caps. All right, we see energy is outperforming by the most. Then after that, consumer discretionary. and then the rest of it is underperforming a little bit. And if we were to look at valuations, we see that the S&P 600, the small caps, actually have the best valuations. They actually have the best opportunities. That's why I'm looking at something like TTCF right now. So valuation wise, small caps are looking the best as far as valuations. Wanted to show you one last thing here. All right, so the last thing I wanted to show you guys is all the sectors that I track on Vanguard. So I'm going to show just a little scroll probably next to me. I'm scrolling with it right now, but I'm just going to put it up next to me. And the reason why it's important to have all these sectors is so that you can understand generally what's going on in the market. So is healthcare going up? Recently, the banks were all going down. So if you can just look into your banking sector and you see, oh, the banking sector fund is down. What happened? Okay, you open up the news and you see that the Federal Reserve decided that they were going to reduce liquidity to the banks. So then you know, hey, usually the winners of yesterday become the losers of today, and the losers of yesterday become the winners of today, right? When that oil trended all the way down and all the way down, it became the winner of this year, this calendar year. Same thing with consumer discretionary. Those things were the losers of last year and they became the winners of this year, right? That's because valuation matters. So anyways, I hope that you guys enjoyed this video. Hope you guys got some value out of it. If you did, make sure you give it a thumbs up. If you like my videos, make sure you give it a thumbs up. If you don't like my videos, make sure you give them a thumbs up, and I'll see you guys in the next video.